Chapter. We're talking real money.
Hello again, and welcome to the Friday edition of the Talking Real Money podcast. Hi, everybody. I'm Don McDonald on the road, traveling across America. Where am I? Where am I right now? Where am I about the time this thing airs? Let me think. I think I am in Pennsylvania, visiting with my daughter and granddaughter. So it's been good so far. At least that's part of it. So I'm here to answer your questions on Friday, as I usually do, or Tom and Roxy do sometimes. And these questions all came in from talkingrealmoney.com on the contact form where you record them, which is really easy to do. And then on Fridays, we answer them. I answer them. And it's easy. And if you want to call us live, you want to actually talk with us, have a conversation, well, then all you need to do is call us on Saturdays from 3 p.m. to 5 p.m. Eastern at 855-935-TALK. That's 855-935-8255. Every Saturday, 3 to 5 Eastern, noon to 2 Pacific. I'm there, Tom's there. One of us is going to be there taking your questions unless it's a major holiday. Otherwise, we're there for you. And also, we're there for you all the time at talkingrealmoney.com, which is where this question came from.
Hi, Don and Tom. This is Mike from Minnesota, calling back with part 2 of a question you answered for me a couple weeks ago. Just a quick recap before my part 2 question. I had mentioned that I plan to retire when I turn 65 this coming December. I don't plan to collect Social Security until I'm probably close to age 70. Now, I have about $1 million in a Vanguard IRA and about another $1 million in a Fidelity 401k through my employer. I'm selling my property for $500,000 in September and moving in with my fiance. You gave me some thoughts on how I might want to invest that $500,000 so I could live on the income for the next few years until I supplement that with Social Security in probably 4 or 5 years. Now, I was listening to your podcast this evening when I was working out, and the episode was called Where Dave Ramsey is Wrong. You had a caller, his name is Mark, and he mentioned my name and my question from part 1. My ears perked up. He had some thoughts. He mentioned the elephant in the room that perhaps wasn't addressed with your answer to my part 1 question, and that was about potentially converting my IRA from Vanguard to a Roth IRA and maybe even my 401k at Fidelity once I retire, also to a Roth IRA. I would love for you to articulate your thoughts on maybe the advantages, the disadvantages, and how I might go about doing that. Thank you so much, and I can't wait to hear your reply.
Well, Mike, I remember both calls really clearly. I had given you advice on how to live off that $500,000 between when you retire and when you withdraw Social Security. And you talked about how I believe your living expenses were about $60,000 a year. And the caller to the Ramsey topic show said, well, gee, you got $2 million in your IRA and your 401k, and it's going to be there for another 10 years. That could easily double. And yeah, it could. It could conceivably double. Rule of 72s says that if you've got 10 years and you make 7%, your money doubles, which would put you at $4 million that you're going to have to start taking, on which you're going to have to start taking required minimum distributions. So the caller's advice was, you're in a low bracket right now. So while you're in a low bracket, we'll go ahead and start moving every year, move some of that IRA or that 401k into a Roth. Move the IRA first, the 401k later when you start moving that into an IRA anyway, just to consolidate, and start moving that into a Roth. Do a Roth conversion so that you pay the taxes now, get them out of the way, and go ahead and grow tax-free because you're going to get kicked into a higher bracket is what he's saying. And he's right. You're probably going to be in a much higher bracket in retirement. So you'd be saving money by paying the bill now. So that's what that's what that was all about. And I think that was very, very good advice. I do. And, as I said at the time, the call was mainly related to filling out that income hole. But yeah, the conversion would make great sense. I think great sense in your case. Thank you very much for your question again. And now I do believe we have another one.
Hi, Tom and Don. This is your number one fan in Ohio. Tom, I'm looking forward to meeting up with you at Kime when you come through Ohio in July. My question for you is, I am about to inherit my father's brokerage and IRA accounts. It's actually divided amongst several siblings. He did have his accounts at Edward Jones, and the plan is that Edward Jones will be opening accounts for all the siblings, 2 accounts each, one for the IRA, one for the brokerage, and then each, the funds will be transferred in kind to those accounts. Is it really necessary that those get transferred directly from one Edward Jones account to another Edward Jones account before I can take control of those? Or do you believe that it's possible for them to move my portion of inheritance to, say, Schwab or Fidelity? Not sure how that works. Very interested in your comments. I realize I'll be liquidating and reinvesting those funds to my liking and likely not continue to hold the funds that my father had. Thank you very much.
Well, you could just have Ed Jones transfer those assets to another account with whomever you choose, a discount broker or whatever company you decide to go with. However, I think just for sheer simplicity and probably some time saving, just go with this plan. Because you see, if you ask them to move it to another account or to other accounts, there may be some foot dragging. I've heard of it happening because nobody likes to lose assets on which they're making money. They'll stop making money on those assets. So I would go ahead, because they're moving everything in kind, so there's no new commission being generated. They're not going to charge you anything. Let it all get split up into the right accounts. The right brokerage account in your name, the inherited IRA in your name, and then go to Fidelity or Vanguard or Schwab or whomever and give them those account numbers and those account statements and let them bring them over for you and bring them over in kind. Because they can do that. If they're mutual funds or stocks or whatever it is, unless there's some sort of wacky proprietary product, most things can be brought over in kind, don't have to be liquidated, and then you can liquidate them in a planned fashion, in a way that maximizes tax benefits, minimizes tax detriments to you. So I think I would go ahead and let them do it. There's no downside to letting them split that up, and I think there's at least there's some upside from a time standpoint, would be my guess, because when the other firm goes after it, it happens faster. When your new company gets the assets, it tends to go faster. So that's how I do it. Thanks so much for your call. Thanks for listening, and I'll hopefully get to see you in Ohio at the Kime Home Improvement Centers, where if you've ever been to Kime and you stayed until the store almost closed, well, thank you for shopping at Kime. That was me. Also, their radio commercials. Okay. Well, and their videos. You could just go to their website. The videos there, they're in my voice, too. All their home improvement videos. Well, not all, some. Let's see. We've got more. I've got another question that came in through talkingrealmoney.com right now.
Hi, Dawn and Tom. My husband and I are in our early 40s. We have around $115,000 with American Century in the fund AOGIX. I put in around $108,000 in 2021 by rolling in retirements from various previous employers, and $7,000 of growth seems to be lagging. The expense ratio, according to Google, is 0.93, which also seems high. I have 50,000, though only 36 is vested from another previous employer that's with Empower in the Vanguard Target Retirement Trust Plus 2045 fund. I would like to consolidate my retirement accounts, but I'm hesitant to move more money into AOGIX of American Century in general, considering the fees of active management. I also have a retirement account with my current employer, 60,000 in RDF 2045. What do you suggest I do to maximize my retirement savings? Should I move everything to the Vanguard Target Retirement Fund or some in total market ETFs such as VTI? My husband seems quite pleased with his ACFOX. Should I move to that? I started late and I'm trying to get caught up, so I'm interested in possibly a bit more risk than average. Thank you.
I think you're probably wise. Congratulations, you're doing a great job saving. If you're not fully vested in your Empower account, then, you leave that alone until you are. Then you can start combining everything together into one IRA account. But for now, I don't know why you're using actively managed funds. We see no evidence, not just us, everybody sees no evidence that in aggregate, actively managed funds beat indexes or passive funds that just build a portfolio based on certain rules. We see no evidence. As a matter of fact, the longer you look back, the worse actively managed funds look. And they're charging you a lot of money, as you said, for that activity that's supposed to improve your performance. In neither of your funds, yours or your husband's, are we seeing outperformance commensurate or that justifies those higher fees. Your fee is ridiculous, and that's ridiculous for a fund of funds. Too high. First thing I want you to do, go to talkingrealmoney.com, take the risk quiz just to make sure that you're comfortable psychologically taking on the risks of the whole market. What you have both done is focused really heavily on large cap growth, which, lucky for you, has done pretty well lately. The areas that haven't done as well are small company stocks, value stocks, those kinds of things. They haven't done as well, which means you probably would rather be buying more of those than more of the large company growth stocks. So you'd rather have value instead of growth and small instead of large a little bit. You don't really have either of those in either of your portfolios. So I would, if you just wanted to go really simple for yours, I would go with something like VT at Vanguard, the Total World Stock Index. It doesn't overweight value or small, but it's dirt cheap. Like 10% of what you're paying right now. The other option, though, that gets you a small and value tilt is AVGE, the Avantis All Equity Fund, which again is 100% stocks, so you need to have a very high risk score to be able to tolerate those. But you've got the time, and you're a good saver, which means if the market in the near term goes down, you will be buying more for less. You see, you're still in the accumulation phase. When you're in the earlier parts of the accumulation phase, you want the stock market to go down. You do. You want it to go down early. You want it to go up later. Now, we don't know when it's going to do either one, but you want it to go up later. So I would, if you really want to have a well-diversified, aggressive, rules-based, not actively managed fund, I don't think you could go wrong, very wrong, longer term with AVGE. You will have some pretty scary times once in a while, but historically, we've recovered from those. Who knows about the future? You're doing a great job saving, though. Keep it up, but yeah, get rid of the active management. Thanks so much for the question, and let's take another one, shall we?
Hi, Don. Question for you. I was recently listening to an episode where you were talking about Vanguard's Advisors Alpha study, and one of the biggest single contributors to an increased return was behavioral coaching. Knowing you're not a psychologist, my question is this. I found myself just really, really focused on investments and whether or not I'm doing it right, to the point where I read reputable studies, listen to your podcast almost every day. I think I'm in a good place. I have a reasonable safety net with my emergency fund. My 401k has been sort of realigned with some recommendations that Tom has made previously. And then I have a small Roth IRA that I do all AVG in. So my question is more like, how do you just tell people to relax? Sometimes good is good enough, and to not obsess that maybe you need to make one more little change, or if only I did this. I'm not actively trading. I'm not actually like doing anything per se, but I just find myself super fixated on trying to learn more to the point where I just want to sit back and enjoy a little bit. I'm just curious if you have any advice for folks that sometimes good is good enough, and try not to worry about these things. Hope that makes sense. Thanks.
Sometimes good is good enough, and try not to worry about these things. There you go. I'm sorry. I couldn't help it, because you got it right. You're absolutely right. We've been taught to obsess over investing. And I think major publications have a hand in that. I certainly think a CNBC or Fox Business has a hand in it. I hope we don't, because our message has been good is good enough. Relax. It's kind of like determining your risk profile. You want to know how much risk you can tolerate. That helps you. But then you need to know how much risk you need to take. If you're doing fine with a lower risk portfolio, just because somebody says it might be better to take the higher risk, why would you do it? You're doing well enough. Now, I find personally, when I become a little obsessed with something in life, I need to find something to replace it. Some new passion, some new interest that will take me off in another direction. Easier said than done, and I'm not a psychologist, but I've lived long enough to know that there is a point where good is good enough. And you need to find something to fill that time that you spend trying to learn more about money. There's not that much to it. The problem is the people in the industry would like you to believe it is far more complicated than it is. So the first thing you should do, never turn on CNBC or Fox Business. Try to read, if you read the Wall Street Journal or any other magazine, read it for the personal finance stuff, not for the markets. Don't pay any attention to the markets. Just you've built that good portfolio, I hope. Leave it alone. Let it do its job. And you go enjoy the fruits of all that labor you've put in. Eventually, you just have to do that. Say, I'm going to enjoy my money. And then do it. And thank you. And call anytime. And only listen to us, of course, because we keep you calm. Now, oh, by the way, I just want to remind you, call us on Saturdays if you want to talk one-on-one, 855-935-TALK, 855-935-8255. Saturday, 3 to 5 Eastern. And now, to our final question of the episode.
Hey, Don. This is Jeff in South Carolina. I love listening to you, and I hate that your U.S. tour starts north of me and continues further north. Maybe we will get to see you on next year's tour. I have a question about REITs. In my Roth IRA, I'm following Paul Merriman's Ultimate Buy and Hold ETF portfolio, which includes VNQ, the Vanguard Real Estate Index Fund ETF. I'm doing my rebalancing and wondering if I should stick with my allocation and buy more of this fund since it's below my target percentage, or just let it continue where it is, or even sell it all and just stick with stock and bond indexes. What do you see as the role, or is there a role, for real estate ETFs or REITs in one's portfolio?
There is a role for REITs, and a REIT ETF particularly, and of course something as inexpensive as VNQ. There is a role for them as a small portion of the portfolio. And if you're following Paul, it's a small enough portion. And the whole point in rebalancing is to do that thing that you're tempted to do. It's not doing well right now. I don't think I should put any more into it. Why would I put any? Maybe I should just get rid of it. Maybe real estate's just not going to do that well anymore. Well, real estate is not the greatest investment going, like a lot of people would want you to believe. But the fact is, real estate doesn't correlate particularly well with the stock market over long periods of time. So therefore, it might zig when the stock market zags or zag when it zigs. So this rebalancing is so powerful because it's a disciplined process. So you always go back to your proper allocation or close to it every time you rebalance. So no, do not kick it out of the portfolio just because it's done badly. That all that means is that, hey, maybe one of these days it'll finally perk back up, these REITs. Now, this is commercial property more. It's not here's where we get confused in real estate. We confuse the price of our house with the rest of the real estate market. And boy, those don't correlate either. Housing prices are through the roof. Individual single-family houses. Whereas many commercial properties, particularly office space, are suffering a big downturn. So, and that's going to affect your REITs more. So, no, the bottom line is always rebalance. Always, always, always rebalance. No matter what you think of the horrible investment you made, it just didn't do well. All the other stuff is better. Maybe I should put all my money in the other stuff. That will destroy the discipline. Don't do it. Do not do it. Thanks for the questions. These were good ones. I really enjoyed it. Thank you all. If you want to send questions in, you just go to talkingrealmoney.com on the contact form. And if you want to follow the trip across the country, you just go to Talking Real Money and click on the little button right next to the Airstream there. And I'll see some of you along the way every now and again. So, and by the way, we did miss South Carolina. I apologize. We're storing the trailer. We store the trailer in North Carolina, primarily because my mom is there, but also because it's a lot cheaper than storing it in Florida. Did I tell you about the show? Yeah. Call the show on Saturdays, 855-935-TALK from 3 to 5 Eastern. If you want to meet with one of our advisors for free, for nothing, with no cost, no obligation, no high-pressure sales pitch, go to talkingrealmoney.com and click on the Meet an Advisor button. And just keep listening. Tell your friends. Thanks for doing it. Thank you so much for telling people to come over here where we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.